Welcome to the Killik and Co podcast. It is the 1st of September, and this does indeed look like being quite an important week, particularly for the ECB. On Thursday of this week, really all attention will be on President Draghi of the ECB. The question mark is to what other things he can do to try and stimulate some growth within the European economies. A lot of this speculation was built on the back of the Jackson Hole conference that took place, where many of the world's leading central bankers all met for a conference, and just the language that came out from that conference has led some to believe that action is on its way, and this is obviously the first opportunity for him to put that into place. However, he has warned that really the central bank can't do it all themselves. They have to look at reforms within the sort of fiscal policies of respective European nations, and that begs the question whether he will go first or indeed he will hang this over the whole sort of Europe as a potential should he get some sort of agreement from European economies. So markets, as I say, will be focusing on that. In terms of today, well, the US markets are closed for Labour Day, and as a result of that, European markets can tend to be a little bit quieter as we see some positioning ahead of that all-important note on Thursday. We have the Bank of England also coming together. Last month we saw that 2 of the 9 members of the Policy Committee decided to go for an earlier rate rise, and the question mark, of course, is whether or not others will be joining the camp. We won't know that this week, but we will indeed find out the decision from the UK. And indeed on Friday, just turning back to the US, we have the all-important non-farm payroll numbers, which has been a good lead indicator for tightening of policy there with the US Fed. And really what they want to see, of course, is wage inflation start to pick up now. That will be showing signs that capacity is starting to come out of the system. So really an all-important macro week. In terms of company results, well, it's a much thinner on the ground this week, but 1 or 2 to highlight. Ashstead Group here on Wednesday has been a company that has had an extraordinary 5 years. They invested heavily in CapEx. This company rents out building equipment in the US and indeed in the UK, where it trades under A Plant. And that well-invested group has seen the benefits of that by taking big market share from smaller competitors, and the share price has been one of the best performers during that time, with many analysts saying there's more to come from Ashstead. So 1 or 2 ahead companies, but really it's going to be all about the ECB for this week. And indeed, just to take a look at some of the charts ahead of that, and really you can see that over the summer months it's all been about euro weakness. It really was becoming an issue, the uncompetitive nature of Europe being able to export its way out of problems, and many leaders within Europe were arguing for a lower euro. Well, that's certainly what they are beginning to get, seeing a retracement against the dollar from 139 down to sort of year-to-date lows at 130, 130. So certainly currency markets beginning to speculate for more action, particularly at a time when, as mentioned before, the US is tightening policy, starting to withdraw from its own QE policies, which it should have expired by around October this year. So that sort of mismatch in where both regions are at in terms of their recovery is leading now to some quite concerted action on the euro to the downside. If we look just sort of to Japan, I just want to briefly touch on Japan, because whilst we talk about QE, it is a reminder that QE policies that have been affected both in the UK, US, and of course this very large expansion of the government balance sheet, of the central bank balance sheet in Japan, has been all designed to try and stimulate some inflation, some growth, and start to raise the view of where long-term interest rates are going to be. But as you can see from the yields on 10-year Japan, it continues to have the opposite effect. Yields continue to decline from the start of the year, where we were approaching sort of 0.75% down to sub 0.5% at the moment. And it really is the experience of Japan over the course of the last 20 to 25 years that continues to be really at the back of many central bankers' minds as to what to try and avoid. Japan has gone on an extraordinary exercise in trying to stimulate growth at the moment. but those yields continuing to decline suggests that the market is still to some extent not subscribing to where the longer term inflation and interest rates outlook is for Japan at this stage. This chart, a little bit confused, but it is telling us an important story, turning back here to the US. What we're trying to do here is to really look at the relationship between the money or the yield that you would receive if you put money out for 5 years with the US government compared to what you would receive over 30 years. And you can see that relationship is very firmly on the decline. It is tightening, the spread is tightening. And really the sort of one aspect of this is that whilst the talk within the US is about stronger economic growth, and indeed second quarter demonstrated that they saw stronger growth, and whilst indeed we're talking about not only the reduction and the elimination of QE, but also when will interest rates go up in the US, what this is telling you, and it's much more forward-looking, is that whilst rates may go up in the near term, they don't necessarily see rates holding much higher in the long term at the moment. So expectations of growth, expectations of inflation over the longer term coming down by that chart. Interesting to note that it is really hitting a 1 or 2 year low at this juncture. So that is something markets are talking about, just looking over the very short-term sort of view of interest rate rises into where we're heading in the longer term. It could be that we're heading into a much longer period of very low growth indeed. Back to stocks, because whilst the sort of top-down approach is indicative of more interesting concerns, certain stocks, certain sectors continue to perform well. We've been talking about Merck through the summer, and I think it's just worth highlighting that particularly on their oncology work, how there's an exciting portfolio there of products that's coming through from Merck, hence the reason for having some exposure here. And so over the weekend, some very encouraging data coming out on one of their tests at the moment, which had analysts busily and excitedly writing this up on Monday morning. So I'm thinking that those shares could continue that current upward trend at the moment. Merck obviously being the US version of this, it comes at an interesting time for particularly UK portfolio investors who have been more typically exposed to the likes of GlaxoSmithKline, suddenly seeing that business is going through a little bit more turmoil, with the Sunday Times this weekend talking about some of the shareholders and management coming into some sort of argument about future strategy for Glaxo. So it does feel as if within the sector there are some winners and losers clearly emerging here at the moment, and hence the reason why we added Merck to our list over the summer months. And finally, well, we couldn't not talk about Tesco from last week. They have taken the difficult decision to cut the dividend. It's by far more than the market could possibly have expected, I think. The prop for Tesco's share price in light of the recent warnings was the fact that the dividend yield on the stock was perceived to be a level of support, but they've cut that by 75%. And that's taken, as I say, a major prop away from the valuation. Forecasts have been downgraded. This company did achieve a peak 3 billion of profits. It's now down to 2.4 billion, so we're 20% retracement off the high. And really the major concern here is that a price war is ensuing. They're doing this to conserve cash, to be able to sort of fight hard, and fight hard they will in this area. But the question mark is, of course, where is the bottom? Where do they ultimately get to in terms of future profitability of this business, the future retracting of the asset base of Tesco, unwinding some of those large hypermarkets that were created over the course of the last 10 years. And where does it leave, of course, the dividend policy? So the yield was 6%, it's now down to 1.5%, assuming that interim is indicative of the way forward. So it's turmoil in the sector at the moment, and it possibly needs one or two of the smaller players to be taken out and a market sort of re-emerge around food retailing at the moment. So Tesco, no signs, I'm afraid, of the bottom of the Tesco share price until there is some clarity about where this price war could head.